They say it's never too late to start, and while that's emotionally comforting, it's not financially accurate. If you start compounding at 50 the same way someone did at 25, the math isn't just different, it's brutal. It's not about how much you believe in the strategy. It's about how long the strategy has to believe in you. And yet every day people are told the same tired line. Just be patient, and it'll grow. But here's the truth. Patience only works when paired with time. And if time isn't on your side, you need a different weapon. Let me tell you about Martin. He's 57, spent most of his life raising kids, paying off debt, keeping the lights on. Compound interest? He thought that was for rich people in suits. At 55, he inherited $30,000 from his mother. First time in his life, he had real capital. He opened his laptop, typed in "best way to invest late in life," and hit a wall of advice that made him feel even more behind. Everything was either start early or wait it out. But what if waiting isn't an option? What if you only have 10 or 15 years left to make your money move? Martin didn't need optimism. He needed a new framework, and that's what this video is about. Before we go deeper, let's clear something up. This series isn't telling you it's too late. Quite the opposite. But we are saying that the way you compound has to change when you start late. You can't rely on slow exponential curves. You need shorter loops, faster stacking, and a more agile mindset. That's what we'll explore right now. And if you haven't seen part 1, 2, or 3 of this compounding comeback series, I recommend watching them after this. You'll see how everything connects. Links are below the video. And if you are new here, subscribe to the channel and let's dive in. Let's kick things off by facing the elephant in the room: time compression. Compounding isn't just about rate of return. It's about how long that return gets to repeat itself. And the brutal reality is this: if you start late, you've already missed the most powerful part of the curve, the back end, where the real momentum kicks in. That's not fear-mongering. That's exponential math. You can't bend time backwards, but you can change the trajectory going forward. Here's the key idea. Compounding rewards not just those who start early, but those who stack aggressively and reinvest strategically once they do start. If you're 55 and trying to mimic the slow and steady path of someone who began at 25, you're not compounding, you're coasting. And coasting doesn't create freedom, it creates frustration. Think of it like planting a tree. If you plant an apple seed at 25, by 60, you've got a tree bearing hundreds of apples each season. But if you plant that seed at 55, you don't have time to wait for it to grow at its own pace. You need to transplant a young tree, use fertilizer, water it daily, and maybe even use a greenhouse. In financial terms, that means higher contributions, smarter allocation, and maybe even taking calculated risk you wouldn't have needed before. The goal shifts from watch it grow to build it faster. And here's what most late starters miss. Your biggest asset now is focus, not time. You may not have decades, but you do have clarity. And with the right framework, you can collapse decades into years. The key is changing the formula. And that's what we'll get into next. Moving forward, let's talk about what most people instinctively do when they realize they started too late. They try to catch up with compounding by doubling down on savings. More money, less spending, no vacations, sacrifice everything. Sounds noble, right? But here's the trap. Doubling down on savings isn't the same as doubling results. In fact, without the right structure, it can burn you out before it builds you up. Here's why. Compounding isn't just about input, it's about acceleration. You can throw an extra $500 a month into an index fund for the next 10 years, but if your money is still sitting in low-yield or overly diversified positions, you're not compounding. You're just parking money. It feels responsible, but it doesn't change your reality. That's why most late starters feel stuck even after ramping up contributions. They're playing defense with a formula that demands offense. Now, this doesn't mean you need to become a day trader or chase risky returns. but it does mean you need to shift from just saving more to building smarter. That means tighter asset selection, purposeful reinvestment, using cash flow to acquire productive assets, not just build balances. And yes, maybe even rethinking your relationship to debt if leverage can buy you time you don't have. Wealthy late starters don't just save harder. They play the game differently. They focus on velocity, not virtue. And that mindset shift changes everything. Coming up next, we'll explore exactly what that new game looks like. Because the old rules, they weren't written for people starting at 40, 50, or 60. But the new ones? They're built for speed. Let's get into it. Let's now shift from the frustration to the formula. Because once you accept that traditional compounding timelines aren't on your side, the question becomes, what actually works if I'm starting late? Here's the truth. You need a new game plan. One that doesn't just tell you to hustle harder or save more, but one that actually shifts the structure of how your money behaves. The wealthy do this all the time. When they start late, or even when they're rebuilding from scratch, they don't try to mimic the 25-year-old's compounding plan. Instead, they focus on stacking compounding levers together: cash flow, asset growth, strategic reinvestment, and yes, even selective leverage. Why? Because when time is short, you need velocity, not just volume. Let me give you an example. Imagine someone in their 50s trying to catch up by throwing everything into a 401k or index fund. That's okay, but it's also slow and locked away. Now imagine they instead use their cash flow to invest in a mix of dividend stocks, high-yield REITs, and maybe a cash-flowing side business or rental. Suddenly, the income is reinvestable. The cycle is alive. Compounding isn't trapped. It's moving. That's the key. When you're late to the game, you can't afford to have idle money. You need compounding that breathes, that earns, reinvests, earns again, and builds layers. You need a portfolio that's alive, not frozen. This is where flexibility beats rigidity, and clarity beats complexity. You don't need 20 funds and a dozen accounts. You need a system that multiplies, one step at a time. And coming up next, we'll break it down even further. I'll walk you through the 3 foundational pillars of this smarter compounding model. It's not a fantasy. It's how late starters get ahead without gambling or burnout. Let's build it together. So, what does a smarter compounding model actually look like for someone who's starting late? Let's break it down into what I call the 3 pillars. And if you felt overwhelmed before, don't worry. These aren't magic tricks. They're practical, grounded, and powerful when combined. Pillar 1, accelerated cash flow. You've got to start feeding the system with more fuel. That means increasing the amount you can reinvest, not just once a year, but every month or quarter. This doesn't mean cutting every joy out of your life. It means getting strategic with your time, energy, and skills. A side hustle, freelance consulting, even renting out an asset you already own. Why? Because every extra $100 reinvested monthly beats a one-time lump sum 10 years from now. The time window is shorter, but the cash flow is continuous. Pillar 2, liquidity with yield. Traditional retirement vehicles are important, but they're also restrictive. Late starters need access to their gains. That's why dividend-focused ETFs, covered call funds, and even short-term real estate plays can outperform traditional compounding because they allow reinvestment without penalties or delays. You're not just sitting on paper gains, you're putting real dollars back to work. Pillar 3, layered leverage, used intelligently. No, this doesn't mean going deep into debt, but it might mean using your creditworthiness, time, or even someone else's money, like partnerships or seller financing, to speed up growth. If used with clarity, leverage can collapse a 10-year plan into 5 without exploding your risk. The key is knowing your downside before you ever commit. Put these 3 together: stronger cash flow, accessible high-yield assets, and intelligent leverage, and you've got a compounding engine that actually runs on your timeline. By the way, if you're enjoying Part 4 of our Compounding Comeback series and want Part 5 sooner, drop the word comeback in the comments so I know you're with me. All right, coming up next, we're going to look at the most common mistake people make when trying to catch up, and how to avoid building a fragile house of cards when what you really need is a fortress. Here's what often happens when someone realizes they've started too late. They panic, and that panic usually leads to one of two dangerous choices. They either get overly aggressive with risk, or they retreat completely and give up. Neither ends well. Let's talk about the first one. Some people think, I have to make up for lost time, so I need huge returns. That's when they go all in on speculative stocks, crypto, or high volatility options with no margin for error. It feels bold, but it's not a strategy. It's a gamble. And if the market turns on them, which it often does, they're left with even less than they started with. One bad trade can set you back years. That's not compounding. That's roulette. The second mistake is more silent, but just as dangerous. Some people freeze. They say, it's too late. I'll never catch up. What's the point? And so they do nothing. They sit in cash. They avoid learning. They let shame or regret make their decisions for them. But here's the truth. Even at 50, 55, or 60, you still have more runway than you think if you act intentionally. What the wealthy understand is this. Compounding is about discipline and positioning, not perfection. You don't need 100% returns. You need consistency, access, and the ability to pivot. And you need to stay in the game long enough to benefit from it. That's why building a plan you can actually stick to, one that factors in your timeline, your income, your real life, is 10x more important than chasing big wins. Because late starters don't have time to recover from major losses, but they do have time to build momentum if they do it right. Now, if you're wondering what that looks like in practice, stay with me, because coming up, we're going to break down a simple yet powerful compounding strategy designed specifically for late bloomers. And it might change the way you see your financial future. Let's now talk about what actually works if you feel behind. Because here's the reality. You can't go back and start earlier, but you can use smarter strategy to go forward faster. The key is not to copy the compounding plan of someone who started in their 20s. It's to build one that works because of your current stage, not in spite of it. So here's how late starters play offense and defense at the same time. First, stack intentionally. That means you cut the fluff and increase your contribution rate as much as possible, but only toward investments that actually compound long-term. No short-term noise, no hype chasing. Focus on assets with staying power, diversified index funds, solid ETFs, and dividend payers with reinvestment plans. Automation becomes your best friend here, because when your system is automatic, your momentum becomes inevitable. Second, protect the base. If you're starting late, you don't have time for reckless losses. That means keeping your emergency fund tight, keeping high-interest debt under control, and avoiding timing traps. It also means resisting that voice that says, take a big swing. The wealthy don't win by swinging harder. They win by swinging smarter and protecting their base while they grow. And third, accelerate with purpose. This is the wild card most people miss. You don't just contribute more, you find ways to increase your capacity to contribute. That could mean starting a small side business, negotiating a raise, or optimizing your tax situation. The point is, even if your investment returns are modest, your ability to fuel the machine increases dramatically when you increase what goes in. This late starter strategy isn't flashy, but it works because it's designed for the reality you're in, not the fantasy you wish you had. And it doesn't rely on hope. It relies on leverage you can control. Now, coming up next, we're going to talk about something no one prepares you for, the emotional side of starting late. The fear, the shame, and most importantly, the belief reset that has to happen if you're going to move forward with confidence. Let's get real for a second, because behind every late starter strategy, there's a human story. And it usually starts with a feeling no one wants to admit: regret. Regret that you didn't start sooner. Regret that you blew money on things that don't matter now. Regret that maybe it's too late. But I need you to hear this clearly. Regret is not a strategy, and it's not your identity. It's just a feeling. And like all feelings, it passes when you replace it with action. The truth is, you don't need to have started in your 20s to build real wealth. What you need is a decision right now to stop comparing timelines and start focusing on what's still possible. Because there is still a path forward, and you're already on it, just by being here. Let me tell you something that wealthy late starters understand. The best time to start wasn't just years ago. The best time is right after you wake up. And if this series woke you up, that means your clock just restarted. This is your new day one. So here's your emotional reset. Instead of thinking, I'm so behind, start thinking, I'm finally aligned. Aligned with strategy. Aligned with your values. Aligned with a plan that isn't based on fantasy, but based on reality. And in that space, progress can happen fast. Not because you're lucky, but because you're finally focused. And look, you're not alone. A lot of people in the comments of this series have said the same thing. I wish I knew this sooner. But here's what they're realizing, and what I hope you will too. The power isn't in what you missed. The power is in what you do next. And that's where we're headed next. In the final part of this series, I'll walk you through a powerful shift that brings everything together. No more theory, just a clear, actionable step you can take starting today, even if you're not working with much. It's time to move from ideas to results. And if you want a head start, I've added my referral link to public.com below. It's the investing platform I personally recommend to begin putting this into practice with real flexibility. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.